Hey everyone, Couch Investor here with another video for you today. Before I start the video, I just want to say thank you to everyone that has been subscribing to the channel. We have reached 100 subscribers, actually 107 subscribers as of today. My goal was to reach that by the end of the month, so we're 2 weeks early, which is awesome. So again, thank you everyone that has been subscribing and liking. And if you haven't subscribed, maybe now's the time, so hit that subscribe button and enjoy the videos. So my last video, I talked about Hilton and Park Hotel and Resorts. This was the first video in the hospitality series. Now, today I'm gonna actually do another video as a special thank you to you guys about, well, the most talked about topic of the week. I'm gonna talk about some oil companies, going over their balance sheets and giving you my personal opinion. So, without further ado, let's get started. So first of all, let's see at some short graphs. As you can see here, oil prices have gone down drastically because of the coronavirus. We'll explain in short why that happened. Well, first of all, since everybody is staying home, there are no flights, nobody's driving or whatever, companies need less oil, but big companies that or countries that are still producing oil, they are producing and having way too much oil, and they don't even have storage to put it anymore. That's why this week, well, the oil prices have plunged under zero because, well, nobody needs oil right now. Literally, no flights, barely cars. So that's why production, well, has stopped in some countries, and obviously that's why the prices went super low. Now, before all of that, we can see here that the world's production and consumption was actually on the rise, almost at its all-time highs before the crash. Obviously now the consumption has gone super low. The production has slowed down a bit, but still you see there's a huge gap difference between consumption and production. And that's the main reason why the price is so low. Because let's say you're selling apples and suddenly nobody in the world wants to eat apples. You're left with so many apples you don't even know what to do. That's why, let's put it in quotes, you will actually pay someone to take those apples off of you so you have free storage. You free up storage for your other goods and services or whatever you're selling. Now, this is what happened when the price of oil went into negative territory. I think it was minus $37 or so. Then it went back up, but it's supposed to go back up by the end of the year. Consumption will actually outperform the production, but that's to be seen because, as you can see here, we should reach the ceiling by 2030. So we have 10 years time. Well, we know, but those companies that are producing, countries that are producing oil non-stop, and that's where their major revenue is coming from, they have 10 years time to actually profit from all of that, because by 2030 we will have reached a plateau. So there's that. Now, it all started when Saudi Arabia said it will keep up producing oil. Obviously, for them, it's costing them less than $10 to produce a barrel of oil. And for other countries, such as Brazil, Canada, United States, it's almost at $20. So Saudi Arabia started upping their production of oil. Obviously, for them, it doesn't matter if they sell it for $10 or for $12, because they're producing it for what, for 5 or something. So they are still making profit, but obviously they would love to sell their barrel for $20 if they're producing it for 5 and not for $10. But that's one of the main reasons why it started to decrease in price. There's also a war with Russia. The same idea. They want to keep the price up. The others said no. It's a whole political situation there. I'm not going to get into this, but basically that's what started this whole mess. And then obviously people figured out that basically now nobody needs oil, nothing's moving, planes, boats, whatever, cars, they don't need that now. And future contracts of May were expiring, I think 2 days ago or something like that. That put even more pressure on this whole commodity. All right, let's dive into the balance sheets real quick for all three of them. So PE ratio for ConocoPhillips is 5.16, for Shell is 8.43, and for ExxonMobil 12.3. Now to save time, I'll just go over from left to right, as always. So 5-year average PE 16.1, 27.9, 22.4. So they're really now at a discount, let's say. Maybe they're not, maybe now is the actual fair value of things, but as you can see, it's pretty low. The difference between the highest point and the lowest is 69% for ConocoPhillips, 68% for Shell, and 64% for ExxonMobil. Now, if you want to look at the number, just pause the video and you can look more in more detail. But for the sake of this video and to save us a little bit of time, I'll just go over the major points. Revenue, 32 billion for Conoco, 344 billion for Shell, and 255 billion for ExxonMobil. Now, as you can see, there's a huge difference between Conoco and the two others, a bit smaller. So let's get to the cost of revenue. 23 billion for Conoco, 308 billion for Shell, almost 200 billion for ExxonMobil. So that's a gross profit of 9.3 billion, 36 billion, and 55.9. Total operating expenses, very low, but seeing the numbers, that's normal. 2 billion for Conoco, then 12.8 for Shell, 43 billion for ExxonMobil. Operating income of 7.2, 12.9, and 12.7 for ExxonMobil. Now cash, very important aspect in this video, just so you could see after, or you will see the liabilities. You will understand that these companies are not well positioned. 10 billion for ConocoPhillips, 26.7 for Shell, and only 3 billion for ExxonMobil. Now, let's just jump to the total of 16.9, 97, and 50 billion. Non-cash assets, they have property of 42 billion, 238 billion, and 253. Again, here we can see the actual difference in sizes of companies. Again, total 53 billion, 311, and 312. Now in liabilities, short-term and long-term. Short-term, 7 billion for Conoco, obviously very small. For the other two, it's 79 billion and 63 billion. For the long term, a bit higher, 28, 134, and 99 billion, which brings it a total of 35 billion for Conoco, 213 for Shell, and 163 for ExxonMobil. Now, as you can see here, short-term $63 billion in liability when they only have $3 billion in cash. That's ExxonMobil. For me, that's already a big red flag. Obviously, they have nice margins. Not everyone, but Conoco has 28.6% gross margin and 22.30% operating margin. So in this situation, they can lower their margin to survive longer. Wouldn't be an issue for them, but for the other two might be an issue because, well, they have a gross margin of 10.7, that's Shell, and only an operating margin of 6.7, so there's no flexibility there. ExxonMobil has an operating margin of only 5%. Now, liability breakdown in the short term, that's $105 million for Conoco, 10 billion for Shell, and then 20.5 billion for ExxonMobil. As we said, those are the short-term liabilities right here. Now, again, we saw there before. We can go here at the assets. Cash 3 billion, 26 and 10, total of let's say 17, almost 150. But look at this. Stock repurchasing, they have spent $3.5 billion in stock repurchasing. That's Conoco. Almost $9 billion for Shell, and then 594 million for ExxonMobil. In dividend payouts, 1.5 billion for Conoco, almost 12 billion for Shell, almost $15 billion for ExxonMobil. Now, these numbers are huge because they don't have that many, well, assets in cash. As you can see here, that's $50 billion in assets cash, but they're already spending 15 billion of that in stock repurchasing and dividend payouts when they only have $3 billion in cash, 26.7 in cash for Shell. Half of that, even no, more than half of that, goes away in stock repurchasing and dividend payouts. These are the yearly dividend payouts: 1.68 for Conoco, 3.19 for Shell, and 3.48 for ExxonMobil. Yes, it's always nice to get dividend payouts, but for me to see this, it's a huge red flag. Those companies don't have a lot of cash on their balance sheets. So why they're spending so much money on stock repurchasing and on dividend payout makes no sense to me. Current valuation, okay. Now earnings, those are last year's earnings, and this is basically if you're buying the whole company right now, when will you have a return on investment? So Conoco in 5 years, you will have a return on investment. Shell 8.7, and Exxon in 12 and a half years. These are the current reflections on earnings. So if you think they're gonna grow back to their normal state, well, these are their earnings in their current state. 2.33 billion for ConocoPhillips when last year's were 7.19. Shell almost 5, so that's divided by 3 times their earnings. And same thing for ExxonMobil, almost 8 when their last year's earning was $14.3 billion. Now, stockholders' equity, surprising enough, stockholders' equity in ConocoPhillips is actually on the rise. It's rising. Before it was, I think, $31 billion. Now it's almost 35 billion. For Shell, it's actually a bit declining, but not that much that it should be like a red alert. And for ExxonMobil, it's not moving that much. So if you were to invest in one of those 3 companies, you would like to see your stockholders' equity growing year over year. Now, earnings per share was $6.4, $3.9, and $3.48 for this year. I'm not going to show you the average estimates because it's basically changing every day, especially this week, went from 0 to minus something. So these are numbers from last year. And why isn't this? Because it needs to be a point. All right, fair enough. So basically, for me, as of now, I'm not really looking to invest in some companies that are some oil companies. If you can and if you want to, I would suggest to look at maybe energy companies that are indirectly related to oil, or the actual crude oil, the commodity itself. Because as of now, as you can see, those companies are not very healthy at all. For me, they have to stop with stock repurchasing. That would already boost their balance sheet by a lot. Cut the dividend payouts for a year or 2, or reduce it, because again, a lot of money that they can use on their balance sheet to reinvest in the company instead of just, I don't know. Yes, they're rewarding their stockholders, but when you're that unhealthy as a for me, it's a huge red flag. Only good thing is that for ConocoPhillips, your stockholders' equity is growing year over year. Maybe next year is going to be a decrease, obviously, because of the whole situation right now. But for me, personally, I'm staying away from oil companies. I just wanted to make this video for people that are actually interested in buying these companies. Yes, I think you could make some money right now. Obviously, you could have made money 1 day ago, 2 days ago when it was in the negative. But in the long term, um, you could probably make some money because, well, when there's panic in the street, that's when people can make money. But for me, it's it wouldn't really go into my philosophy of investing in stocks. I prefer buying maybe hotel stocks or casino stocks or maybe airlines, stocks with actual cleaner balance sheets and a more logical approach towards the future. And again, oil isn't really something that the world views as a friendly commodity. It smells, it's not very good for the climate. And well, by 2030, I think, well, hopefully most vehicles will be electric vehicles, so that would already cut profit for all those companies by a lot. Maybe planes might look at another option, who knows. But for me, it's a no. It's a no. I'm not going to invest in oil companies, even though I think you can make a lot of money in the short term, but in the long term, I don't want it in my portfolio. So yeah, that's my opinion. If you have your personal opinion, I'm glad to hear it in the comments down below. That will be it for this video. Again, don't forget to like, comment, subscribe, and see you all in the next video. Bye bye.